The Income Tax Act you grew up with, the one your parents filed returns under for 60 years, is officially gone. And yet, most Indians filing their taxes this month still don't know which set of rules actually applies to them right now. By the end of this explainer, you'll know exactly what changed, what stayed the same, and what you absolutely must do before July 31st. Look, if you're feeling a bit of anxiety or just plain confusion right now, you are totally not alone. You've probably been hearing the buzz that a brand new tax code, the Income Tax Act 2025, has completely replaced the old 1961 Act. So you're likely sitting there asking yourself, is the 1961 Tax Act actually dead? Well, yes, it is officially dead. But here's the kicker. You are still going to use it this month. We're essentially living in this weird, temporary, dual system reality right now. You're standing right on the bridge between the old way of doing things and the new era. And you've got to understand exactly how this overlap works before the July 31st deadline hits, or you could end up filing the wrong way entirely. So, here is our roadmap for today. First, we'll cover how the old act still lives. Second, what the new act changed. Third, your July 31 deadline checklist. And finally, we'll wrap up with a quick 3-step action plan. Okay, part 1, the old act still lives. Let's break down this overlap. Notice the crazy contrast happening right at this very moment. If you are filing your returns right now in July 2026, you're filing for assessment year 2026-27. That covers the income you earned back in financial year 2025-26. And because you earned that money before the new act took effect, you have to use the forms from the old act. But, and this is a big but, if you're paying advance tax right now for the future, you're actually operating under the new income tax rules 2026. It's the exact same month, but 2 completely different rule books depending on the task you're doing. Moving right along to part 2, what the new act changed. Get this, the government actually did the unthinkable here. They seriously cut down the paperwork. We are dropping from 511 complex rules down to just 333. And they slashed the number of forms from 399 all the way down to 190. They've consolidated provisions, cleared up definitions. It's a genuine simplification of what used to be a massive compliance headache.
And honestly, one of the best examples of this simplification is the new definition of a tax year. For literally decades, we've had to juggle that incredibly confusing dual concept, right? The financial year, when you actually earn the money, versus the assessment year, when you finally file taxes for it. Well, good news, the new act completely throws that out the window and introduces one unified tax year. It just makes so much more logical sense. If we map this out on a timeline, you can clearly see how it all builds up. On April 1, 2026, the old 1961 Act was officially repealed. But right there in the middle, your July 31, 2026 deadline for ITR 1 and ITR 2 still relies on the old Act's forms for your past income. Meanwhile, as we step into the new tax year 2026-27, the new income tax rules are fully in play for your advanced tax planning. It's a progressive rollout, you know?
8. Okay, this is a super important number if you're a salaried employee. Under the new rules, the 50% house rent allowance, or HRA, exemption has been expanded to a total of 8 cities. Previously, that 50% bracket was strictly limited to just 4 cities: Mumbai, Chennai, Delhi, and Kolkata. They've literally doubled the list. And there are several other massive structural benefits kicking in right now. First off, the new tax regime is offering a basic tax-free income exemption limit of up to 12 lakh rupees. Huge, right? Second, if you absolutely love your deductions, don't panic. The old regime with Section 80C and 80D is still available in parallel. Third, virtual digital assets, like crypto and NFTs, are formally recognized and taxed under a dedicated category now. And finally, standard allowances for things like children's education, hostels, and meals, they've actually been raised to match modern inflation. All right, part 3, your July 31 deadline checklist. Let's get into the immediate to-dos. Depending on how you earn your income, your deadline is going to look a bit different. If you file ITR 1 or ITR 2, your deadline is July 31st, 2026. If you manage quarterly TDS and TCS returns, your Q1 return is also due July 31st. But if you're filing ITR 3 or ITR 4, you actually get a breather until August 31st, 2026. Make sure you know exactly which form applies to you so you can prioritize your tasks. Now, please pay close attention here, because people are falling into some very specific transition traps that can lead to rejected forms or, worse, steep penalties.
First, whatever you do, do not use the old return preparation utility for your new tax year 2026-27 filings. They just released a new one. Second, don't just assume that 50% HRA applies to you now. You've got to check the official CBDT list to see if your city is one of the 4 new ones. Third, if you have business income and you want to opt out of the new default regime, you absolutely must remember to file Form 10 IEA. And lastly, don't get so hyper-focused on your ITR that you completely forget your Q1 TDS or TCS return deadline. Which brings us to Part 4, your 3-step action plan. Let's crush that tax anxiety. Here is your foolproof action plan for the minute this explainer finishes. Step 1. Check your specific form type right now to lock in whether you're racing against that July 31st or August 31st deadline. Step 2. Double-check your utility. Remember, old forms for your past assessment year 2026-27 return, but the new utility for paying advance tax. Step 3. Pull up the official CBDT list to verify your exact HRA city eligibility and limits, just so you don't accidentally overclaim and trigger a notice. The Income Tax Act 2025 has finally given us a streamlined, globally aligned tax code. The compliance burden is lighter, the exemptions are way higher, and the rules are undeniably simpler. But getting through this one-time transition month takes a little bit of focus. You know exactly what to do for July 31st now, but looking ahead, with a 12 lakh rupee exemption on one side and those classic ADC deductions still alive on the other, you have to ask yourself, is your long-term tax strategy truly ready for this new era? Take this plan, get filing, and I'll see you in the next explainer.